Hello everyone, hi, welcome to the channel of Wall Street Mojo. Friends, today we are going to learn a concept that is market risk premium. Now, where does this thing exactly come? See, when we evaluate your weighted average cost of capital, we need to evaluate in that is something called cost of equity. And while calculating the cost of equity, we need something that is called risk premium, right? And of that, we need market risk premium basically. So let's try and evaluate the whole formula and we'll get to know what exactly we are trying to find. Risk-free rate is the first component of the cost of equity as per the 𝐾PAM model, that is capital asset pricing model. Risk-free rate is basically the return or which you get on the treasury bonds or treasury bills or the government bonds, and it should be in currency in cash flow. Beta is basically your sensitivity of the stock with that of the market, and the degree to which a company's equity return vary with the return of the overall market. So beta is basically you can say a measure of systematic risk and is a function of both business as well as the financial risk. Risk premium is basically the difference between your risk from the market and your risk-free rate, because here we are trying to talk something that is what exactly will the investor get something more than the risk-free rate for taking the additional amount of the risk, which is your risk premium. So let's start in evaluating how this market risk premium will work. Market risk premium is basically the additional rate of return over and above the RF, right, which the investor expects when they hold on the risk investments. So this concept is based on the 𝐶APM model, that is capital asset pricing model, which quantifies the relationship between the risk and the required return in the well-functioning market. 𝐶APM model, which is your capital asset pricing model, is equal to the risk-free rate, that is your RF, plus beta into you have market rate of return, that is RM, less your RF, will give you your cost of equity as per the 𝐾PAM formula. Here basically the market risk premium formula is as simple as that: market rate of return, that is your RM over here, and risk-free rate is your RF. So this whole thing is your market risk premium. So let's start. What exactly is market risk premium? See, the difference between the expected rate of return, that is your ER, from holding an investment, and the risk-free rate, that is your RF, is called as your market risk MRP, right? Now to understand, first we need to go back and look at simple concepts. We all know basically that greater amount of risk will lead to greater return and greater losses, right? So why it wouldn't be true for investors who have taken a mental leap from being savers to investors? When an individual saves the amount in treasury bonds, so he expects a minimum return, which is we know as RF. He doesn't want to take more risks, so he receives the minimum rate. But what if one is ready to invest in a stock, and won't he expect more return? At least he would expect more than what he would get by investing his money in treasury bonds. Absolutely, yes. See, market risk premium formula, we know it now very well, right? Now let's take each of the component of the market risk premium formula and try and analyze them. First, let's think about the expected return, that is ER, right? Now, this expected return is totally dependent on how investor thinks and what is the type of the investments he invests in. See, there are following options we can consider from the point of view of the investor. The first type of investor, which is known as the risk tolerant investors. Now, when we talk about risk tolerant investors, if the investors are players of the market and understands the ups and the downs and are okay with whatever risk they need to go through, then we will call them risk tolerant investors. See, risk tolerant investors won't expect much from the investments, and thus the premiums would be much lesser than the risk averse investors. The next thing that we have lined up is the risk averse investors, right? When we talk about this type of investor, the investors are usually new investors we are talking about over here, and they have not invested much in the risky investments. They have saved over their money in the fixed deposits or the savings in the bank accounts, and after thinking over the prospects of the investments, they start investing in stocks, and thus they expect much more return than the risk tolerant investors. So the premium is higher in case of the, yeah, absolutely, the premium is really high in case of the risk averse investors. So now the premium also depends on the type of the investments the investors are ready to invest in. So if the investments are too risky, naturally the expected return would be much more than the less risky investment, and thus the premium would also be more than the less risky investments. There are also two other aspects that we need to consider while calculating the premium. First is the required market risk premium. Now, this is basically the difference between the minimum rate the investors may expect from any sort of investment, right? And less the risk-free rate, right? And the second is your historical market risk premium, MRP. So this is basically the difference between the historical market of a particular market. So over here, I will give an example like NYSE, that is the New York Stock Exchange, and the risk-free rate. Let's interpret the market risk premium. Market risk premium model is an expectancy model because both of the component in it, expected rate of return over here we are talking about, and the risk-free rate are subject to change and are dependent on volatile market forces. Second, to understand it well, you need to have a basis of computing. I mean, the basis you choose should be relevant, aligned with the investments that you have done. See, in normal situation, all you need to do is to go for the historical averages, okay, to use as the basis. If you invest in NYSE and you want to calculate the market risk premium, all you need to do is to find out the past records of the stock, and you have to decide to invest in, and then find the averages. Then you would get a figure that could bank upon. Here, one thing you need to remember is that taking historical figures as the basis, you are actually assuming that the future would be exactly like the past, which may turn out to be flawed. Absolutely. So what would be the right thing? Or what would be the right market risk premium calculation, which would not be flawed and would be aligned with the current market risk condition? We need to look for the real market premium. That's the catch over here, right? And here the real market risk premium is basically your real market MRP. RMRP is basically 1 plus your nominal rate NR divided by 1 plus your inflation rate. Got it? So this is going to be your formula. Now, in the example section, we'll understand everything in detail. Now, let's take an example. Let's see that there are two kind of investment number 1 and 2. Over here, the expected return ER, let's say, is 10, and over here 11 for investment number 2. And we have risk-free rate as 4 and 4. So your market risk premium, in this example, we have two investment, and we have also been provided with the information for expected return and risk-free rate. So of this, we can find the premium, that is P. It will be as simple as that, 10 minus 4, and press Ctrl R. We'll have 6 and 7. So now in most of the cases, we need to base our assumptions for expected return on historical figure, and that means whatever the investor expects as a return, that would be decide the rate of premium. Okay. So let's finally understand the limitation of the market risk premium concept. This concept is expectancy model that cannot be accurate most of the time, but equity risk premium is much better concept than this. If you are thinking of investing into stocks, there are many approaches from which we can calculate this, but as of now, let's look at the limitation of the concept. First, this is not the accurate, it's not the accurate model, you can say, for computation. Depends on the investor. That means too many variables and too little basis of a proper computation. Second, when market risk premium calculation is done taking into account the historical figures, you can say it's assumed that the future would be similar as the past, but in most cases that may not be true. Third, it doesn't take into account the inflation rate. This is really important. Thus, the real risk premium is much better concept than the market premium.